Well, thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. I want to read out a small note. Now, the note says, the recent synchronous global equities sell-off has resulted in a mild exodus of FPIs from India. The re-emergence of the risk of trade appears similar to September 20 and is a result of bundling of multiple worries, which are rising global inflation, asset bubble, US tech stock corrections, and preemptive central bank actions to control the asset bubble. Now, lest you think that this was written yesterday, this was written on Jan 29th. So, there are some similarities which kind of miss our mind, even though we're constantly looking at the markets. The gentleman who wrote this note back then, but has been bullish largely through and through, is Dhananjay Sinha. And he joins us right now to talk about his thoughts on how he sees the current scenario in light of the fact that there has been a bit of a cool-off in equities. Dhananjay, good having you. Thanks for joining in. We'll marry both the global and the local. And since we have you, a bit of the economics as well, Dhananjay. What's your sense about how all of these three come together to tell us what could happen to the equity markets in the near term?
So I think the concern for the market today is that the market has actually run up quite substantially. If you look at how Indian markets have actually responded since March, and also globally, I would say Indian markets have more than doubled. Bank Nifty, for instance, has gone up substantially. And also there has been a cyclical rally, especially in the metal space, in commodity space. So I think all those things are happening. So the market is essentially worried about the way the market valuations have gone up. Globally also, when we see, if you look at the US markets, the total market cap to GDP has risen to almost like 200%. And this has been a significant rebound from the... So I think the market is generally very concerned about the way valuations have gone up. I think what we are seeing on and off are short-term jitters because of the uneasiness because of the valuation. And more recently, what we have seen is this multiple views or on multiple occasions that this whole liquidity that has been provided by central bank will taper off. And more recently, what market has been debating about is tapering of the liquidity, especially from the US Fed. And essentially, people are likening this with 2013 kind of sell-off when taper tantrum happened. And the key arguments out here is that you have a recovering economy world over. Also in advanced economies, all the PMIs have actually been showing a significant rebound. Commodity prices are rising, etc. And in that midst, if you have large fiscal stimulus along with easy liquidity, there is an expectation that's building up in the market that inflation will actually go up in a surprisingly high manner, and then there will be a sudden unwinding of liquidity. We have examined this entire thesis. While we believe that there is a better growth that is imminent in 2021 on the back of steep contraction last year, we believe that even with that kind of rebound and it's sustaining in 2022, it is unlikely that the slack in the economy will go away quite so quickly as the market is actually seeing it, and that reflects in the hardening of the risk-free rate. If you look at the 10-year US Treasury yield, has gone up to almost like 120 or 125, almost like 40 basis points since March of last year. So my sense is that the way I have examined, and I think yesterday Jerome Powell also talked about this, the Fed chief talking about it. So essentially, my view is that based on examination of multiple macro variables, is that the slack in the labor market in particular is fairly high. The decline in labor participation rate has been at a historical low, if you look at the last 50 years or 60 years. And also that unemployment fell by almost like 13 to 15 percentage point when the lockdown happened. So I think if you look at historical cycles, it takes about 4 years, or 3 to 4 years, for the labor market slack to go away and get back to the levels it was prior to the crisis that had happened in 2000, 2004. It had happened in 2008, 2014. Right. So what the market is actually preempting as a unwinding of liquidity is fairly premature, according to me. And as Powell said, Jerome Powell said yesterday, that the position with respect to buying of securities, by buying program of the securities, will continue so long as the slack remains. So my view is that the market might actually be pricing in higher inflation expectation and also unwinding of liquidity or tapering too soon. So overall, I would say that we maintain our view that the liquidity conditions globally will remain comfortable. There will be on and off jitters. Incremental liquidity might actually be lesser than what we saw in 2020, but incrementally it is still going to grow. Even with the lower increment in balance sheet of central banks, what is more important is the money supply, which is multiplier of the base money, and that will continue to grow even with a moderate tapering. So I think overall, from an emerging market standpoint and from an India standpoint, we maintain that liquidity will be sufficiently high, which will actually drive portfolio flows into emerging markets, especially and also in India, especially with respect to the differentiation in growth, in earnings and economic growth differential. I think the liquidity should be sufficient enough to drive roughly about $36 to $40 billion of FPI flows each year in FY. So that's a projection for 2021, 22, FY 21, FY 22, and 23. So we think that in a context that liquidity is going to be comfortable, there will be reasonable flow into emerging markets in India, and hence I would say the cyclical sectors will continue to do well even in India. So I think we are fairly constructive. Any sort of volatility will likely to be bought in. Study of global volatility shows that the VIX index did not really harden too much, even with the worry of hardening in risk-free rate, and also that credit market risk, as measured by various have actually been fairly orderly. So I think I would say volatility has to be bought.
But you reckon, Dhananjay, that this volatility because of forget higher interest rates, but higher yields impacting the perceived discounting factors for multiples, etc., can it bring markets lower by another 4, 5% or 10%, or you rule that out as well?
So I think with the kind of rally that we have seen, a 5 to 10% correction is a good thing, because you need.
Do you think it will happen? But do you think it will happen?
It can happen. It can happen. So it can happen from time to time. So it is unlikely to be a one-way market as we saw in 2020. So we will see every 2 or 3 months, you will see such kind of worries coming back. But by and large, if I'm looking at the next 1 or 2 years, I think there is a sufficiently good scope for a reasonable scope for the market risk premium to still decline. So if you look at the VIX CBOE VIX index, it is hovering around 25, 27 levels. It goes down to 20, bounces back. At a peak level, it goes to 30, 35. But if you look at the pre-COVID level, it used to be somewhere around 10 or 8. So I would say that as the risk-on trade plays out more gradually, I would say going forward than earlier, then you will actually see the risk on playing in, and I think there will be abundant liquidity to actually move that back to 2000 pre-COVID level. And if you look at the long-term chart since 1990s, what we have highlighted is that when it comes down because of better growth and large liquidity, it remains there for a prolonged period of time. So I would say that, yes, people might be worried about valuations and all, but I think eventually earnings will catch up. And I think markets will headed higher from a longer standpoint. So on and off, I think there will be volatility, which is a good thing. I don't see abnormal meltdown. There will be small jitters here and there. Yeah.
Dhananjay, let me try and put you in a bit of a spot. And that comes from the last couple of conversations that we've had, wherein the market was getting unduly worried. But you said that, for example, in a conversation, I don't remember when, but the first conversation that we've had on this program, You mentioned then that you were unequivocally bullish on the banks. And since then, the Bank Nifty gave a very good rally.
Right.
Part 2 of our conversation, you again came out and said that from that point on as well, you believe banks should be bought into, and banks gave a really good rally. So I'm asking you a bit of a tactical hat here. From where we are right now, do you reckon that the probability of a move downwards is higher, or would you continue to bet the house on equities at the current juncture?
So you're talking about banking stocks?
Or the market at large? I think what the Bank Nifty does might well impact the markets too, right?
Yeah, so let's talk about the Bank Nifty. So we have been talking about 40,000 for Bank Nifty. We went up to almost like 37 or 38,000. So we were almost close there. I still hold that view, actually, that 40,000 is fairly a close target. And if you look at the current level, there has been some correction about 5% over the last week or so. And current valuation, if you look at a trailing price to book value, it's currently about 3 times. And if you look at the historical level, still fairly low. So the thing is, the way I look at it is that it could head higher. So on the optimistic side, it could be higher, and I would say that the valuation on the upper side can be 20-25% higher than where we are today. So there is an upside for the banking sector. I think fundamentally what we are looking at for the banks, and I think the thesis remains, is that banks will be a significant contributor to the incremental growth that the economy will see. And we are looking at a situation where, if you look at the third quarter results, I think the stress or the concern on credit cost has actually been lesser than expected, be it the pro forma NPAs or the restructuring requirement of restructuring of outstanding book, and also the collection ratios. Those have actually been trending down. And so this is less than expected. So what we are basically seeing is a greater confidence of banks with respect to lending or willingness to lend. That is coming not just from the Q3 results of various large banks, especially the private sector banks, but also if you look at the RBI's survey of bankers or lenders, there is a significant improvement in terms of sentiment or expectation of demand for credit from manufacturing sector, from infrastructure, mining, retail, etc. So there does seem to be a broad-based expectation of better credit demand in the Q4 of this year. And also the lending standards, which basically reflects the willingness of banks to lend to various segments, has actually eased. That is coming not just from the banker survey, but also the industry survey of RBI. So I think there is a synchronous improvement as far as both the lending requirement and the willingness to lend, both from the banking side and the borrower side. And hence, I would say that operating leverage that we are looking at for the banking sector, given the context that you have historical high margins thanks to lower deposit costs and lower liquidity and high liquidity, and that you have very large capital that banks had raised when they were scared about the impact of the COVID. I think all those things will lead to fairly high lending growth or reasonable traction in the lending growth. And I think the rise in the short-term rate, especially when the liquidity is going to normalize thanks to increase in the CRR and also improvement in credit growth, the increase in the short-term rates will actually imply that there will be greater traction for demand for loans. So overall, I think I'm holding on to the view, and possibly I'm more confident about the operating leverage thesis that we've been talking about for the banking sector for the last 8 months or so. So I think hence I would say when the business cycle for the banks and economy in general is on the improving side, there is no reason to believe that banking stocks will not do well. So I think there will be a greater market share for large private banks, and I think the valuations will be supported. Yeah.
Okay. Dhananjay, is there merit in the argument that while things are looking good on the growth front, a large proportion of Nifty 50's EBITDA is also impacted by the uptick in commodity prices. And while low-cost inventory might have helped some of these sectors tide over the uptick that we've seen in commodity prices thus far, maybe Q4 onwards, while even if top-line growth stays stable, there could be impact on the EBITDA. And
Sure.
therefore, a margin impact coupled with fears of maybe a second wave or a lockdown thereof, we've already seen that in Amravati, plus this yields and the noise around the globe and geopolitics as well, could all have the potential to have a near-term larger impact on equity valuations and equity sentiment.
So, as I said, there will be volatility. I would say that these concerns, the concerns that you have actually cited, many of them are actually contradictory. You can rising commodity prices because of better demand. So that is one side. The other thing is that if there is a lockdown, there will be weaker demand. So I think there are multiple factors that can happen. And there are concerns on global liquidity also. People believe that high inflation will translate into high inflation and low liquidity. Some people also believe that there can be disinflation because of lockdown and all. And as the winter season passes, commodity prices will correct. So people have various reasons to expect a steep correction, especially in the context of the steep rally. So I think there are multiple contradictory assumptions that are there. We have to really look through some of these, and we have to really look at what is the logical end. So the way I look at it is that rise income. So the thing is that that we are assuming that the growth traction that we are seeing will continue going forward as well. So first quarter next year will be abnormal growth because of the base effect. But if I look at the overall picture for next year as well, I think the average growth will still be better on a sequential basis if I look at that. So in the coming quarters. So the way I look at is that with the rise in commodity prices, I think first of all the crude price increase has been higher than what we expected. It reached about 60. It is above $60, and our range was roughly about $50 to $60. The view that we are taking is that the rise in commodity prices, in crude prices, is one. Is a function of recovery in demand because of the lockdowns that have been removed, and secondly, there was there was production cuts as well. So I think there has been a drawdown in inventories, and there has been a sort of a increase in prices because of that. But my sense is that at these levels, there will be it will attract greater supply because the cut in production can actually be eased. So I think at some point of time it will start moving up. So I don't see a significant flare up from here on. It will be sort of a gradual thing, and there will be inventory built up. Also, there will be supply responses that will also happen. So I think that is one side of it. The other thing is that from an industry standpoint, what we are seeing from our channel checks and talking to various companies, we are doing something on building material, pipe business, paints, etc. We spoke to many people, and what we are getting a sense is that companies are now ready to actually increase prices, and there is a good enough demand for that to happen. So there is a certain amount of pricing power that is there, and larger companies, especially in the organized sector, they have gained market share. So I think that will also enable them to sort of pass on the rise in raw material prices. So I think the core cost inflation will actually be passed on as demand on and so I think earnings, I would say, earnings will be a function of how demand pans out. Specific sectors such as autos and then FMCG get impacted more because of spike in raw material prices. But there are multiple other industries, especially in the consumer space, durables and all other discretionary spending, etc., where the pass through pass on of increase in raw material prices actually is easier actually.
Okay.
And of course, the metal space does well, and in rise in commodity prices has also helped sort of increase in demand for credit. So I think that helps the cyclical sectors in terms of their core business. So I think what has to be really looked at is the business cycle. The cost will increase; it will impact various industries in different ways. But by and large, I would say it is a beneficial thing from a operating leverage standpoint. From if I'm looking at Indian corporates.
Okay, so maybe some sectoral rotation could happen, but the broad
Right.
consensus is positive. Okay, couple of spaces, Dhananjay, which are intriguing and would want your
Yes.
view. I don't know if you have a view here, but I'm asking you nevertheless. One is OMCs because of the whole divestment process, and there is I think the Prime Minister Modi's webinar today on divestment. What does it
Right.
do? BPCL seems to be the forefront candidate. So what does it do to the valuations of the OMCs? And therefore, are you constructive there? Part one. Part two is city gas distribution. The noise around that space is just so high. Yesterday, Dharmendra Pradhan spoke about Northeast being 100% done by city gas, etc. And we know that the gas demand is an annual ongoing uptake exercise, so to say. What are your view here on the city gas distribution companies? Because they seem to have run quite a bit as well. So do you have view on either of these two?
So, first of all, I am not very, you would not have seen me being very constructive on PSU companies over the last 10 years or so. So I think by and large, I maintain that view because, there are multiple, risks that arises from government objectives and policies, etc. From time to time, the government tries to sort of come up with some program for disinvestment and all. But by and large, if you look at the last 10 years or so, the governments have actually failed to garner enough resources. So unless there are big reforms with respect to the public sector undertaking, it is very difficult to make money out of it if you look at it. So I think most of the PSU companies have actually not done much. So that's the general view that I have. As far as the OMCs are concerned, I would say, yeah, they would want to sort of disinvest out there. But it all depends on how the under recoveries are actually sort of priced in. If you look at the budget this year, there hasn't been much provisioning that has been made. So I think with a rise in crude prices that is there, the risk still remains with respect to how much will be the under recovery and all, and how much is the provisioning and all. So we'll have to see that. So that is on the oil companies. On the gas thing, I think I don't have a very strong view, but I think over there it is more like a structural thing as you sort of spread the spread of the gas distribution across various urban cities and all. And I think there are pitfalls with respect to how the expansion can happen or how quickly that can happen. So I think there are risks out there. So it all depends on how companies are actually taking the expansion path.
Okay, fair call. Dhananjay, in which case, let me ask you, you gave us a fairly constructive view on banks. You mentioned how while metals may still do well, companies like autos and staples may not. And there's a possibility that they may not. Let's work with an assumption. There's also this whole conversation around chip availability, which may impact global auto production in a meaningful way, which might also impact auto ANGs for that matter. But let me ask you, in this parlance then, if your larger view is constructive, tell us about that one theme, Dhananjay, that one theme aside of banking, where you individually are very constructive for somebody who can put in money for 2-3 years, not bother, and ceteris paribus, create wealth.
So I think two things that we have been talking about. One is the commercial vehicle theme. We are moving out of sort of a deep contraction of roughly about 80% in the first quarter FY21, and we are actually moving out of it. And all the indicators are showing improvement in freight availability and and utilization levels of fleet operators. And we are also seeing a sort of a improved traction of lenders to fund the fleet operators. So I think we have been constructive on a whole gamut of companies who are engaged here, be it the lenders, be it the OEMs, and the I would say the ancillary business. So what we are looking at is so when the commercial vehicle cycle bottoms out, especially in the context of 2 years of sort of very weak performance, it's likely to last for 2.5, 3 years. So we have been constructive on the commercial vehicle space, especially Tata Motors and Ashok Leyland and Bharat Forge in the ancillary side, on the ancillary side, and we have been fairly positive on financiers such as Cholamandalam and Shriram Transport. So this entire gamut of companies will actually continue doing well. And they have run up, but I think there can be further traction, especially the constructive view on the business cycle that we are looking at. So that's one part of it. Second part, I would say, is the building material and housing space. What we are seeing is a fairly strong traction as far as housing sector is concerned. There is a good amount of registration that is happening. There is a reduction in inventory that is happening. I think this is also culminating from the fact that there has been price corrections in various cities beyond also metropolitan cities. So affordable housing, etc., is seeing good traction. That is coming. That indicator is so that is one part of it. The lending rate has actually come down. So on a real rate basis, it is actually lower than 2003 levels. So that is also, so affordability of owning a house is actually improving, and hence I think there is a good traction that is shown in also the various surveys of banks. So I think and also the ground check that we have done of various, while we did this commercial vehicle team, we also did gather that in smaller cities there is good traction as far as housing is concerned. People are buying plots, small houses, affordable housing, and there's a traction that is there. And utilization of fleet operators is also happening because of good traction in building materials such as tiles, granites, and gypsum, etc. So I think that there's a good amount of traction. And typically, I would say that as the household sector sort of starts to use this opportunity, I think you will have a good traction for the next 2 years or so. So I think housing is one thing. The way to really look at you can play it through building materials. So there's a whole host of companies in tiles, pipes, steel pipes, etc., cement, paints, etc. So there is a whole gamut of stuff that will see traction, and the companies we spoke to recently essentially are telling that they are actually revving up for or preparing for better traction for the next 2 years. So people are building capacities in pipes, PVC pipes, etc., and also steel pipes, etc. So which are used for building purposes. Good amount of traction in cement and stuff. So I think by and large plywood as well. So laminates, the plywood boards, etc. I mean, these are small companies, but there is good amount of traction that we might actually see over the next couple of years. So I think these are the themes that one can look at.
Great. Dhananjay, good having you. Thank you so much for taking the time out and speaking to us today. Really appreciate your time.
Thank you. Thank you very much.
And viewers, I hope this conversation helped in more ways than one. He's an astute watcher of the macro. And I think we spoke a lot about the macro part in the beginning, and then a bit about the investing part and themes to watch out for towards the end of the conversation. Thanks for tuning in today.